In 2008, Washington Mutual lost $188 billion in assets overnight. It was the largest bank failure in American history. 16,000 employees walked in on a Friday morning thinking they had jobs, and by Friday afternoon, the building was locked. But here's the part that should genuinely terrify you. Some customers lost everything. Not because the system failed them, but because they didn't understand the one rule that separates people who get every penny back from people who lose hundreds of thousands of dollars in a single weekend. And that rule is something most people have never actually checked in their own bank account. Today, I am going to walk you through exactly what happens to your money the moment a bank collapses, minute by minute. And more importantly, what you can do right now, today, to make sure you are never the person standing outside a locked building wondering where your life savings went. Hey, I'm Joe, and this is Joe Invests. This is the channel where we break down money in a way that actually makes sense. No jargon, no suits, no trying to impress you with words nobody uses in real life. If that sounds good to you, do me a favor. Subscribe and hit that bell so you don't miss the next one. Now let us get into it. So here's the thing most people don't realize. Banks fail way more often than you think. Since the year 2000, more than 560 banks have failed in the United States alone. 560, that is not ancient history, that is recent. The FDIC, which stands for the Federal Deposit Insurance Corporation, keeps a running list on their website. You can go look at it right now. It is honestly a little unsettling how long that list is. And it is not just small community banks in the middle of nowhere. In March of 2023, Silicon Valley Bank collapsed. It had $209 billion in total assets. That made it the second largest bank failure in American history, behind only Washington Mutual. And then literally 2 days later, Signature Bank went down too, with $110 billion in assets, two massive banks in 1 week. According to research from the National Bureau of Economic Research, during the 2008 financial crisis, over 400 banks failed between 2008 and 2012. Economists Levin and Valencia published a study in 2018 documenting that systemic banking crises have occurred in over 140 countries since 1970. This is not rare. This is a pattern. So what actually happens to your money when one of these banks goes under? Let me walk you through the timeline, because it moves fast. Day 1, usually a Friday. Regulators almost always shut down banks on a Friday evening. There is actually a reason for this. It gives the FDIC the entire weekend to sort through accounts, find a buyer if possible, and set up a plan before Monday morning. The New York Times reported that this Friday closing tradition has been standard practice for decades, specifically to minimize public panic. Within hours, sometimes within the same night, the FDIC either transfers your insured deposits to another bank or they begin preparing checks to mail directly to depositors. In the case of Silicon Valley Bank, the FDIC created a brand new temporary institution called a bridge bank, literally overnight, so customers could access their money by Monday. Here is the critical number you need to know: $250,000. That is the FDIC insurance limit per depositor, per bank, per ownership category. If you have $250,000 or less in your account, you are covered. The FDIC has a perfect track record on this. Since 1933, when FDIC insurance was created, no depositor has ever lost a single penny of insured funds. Not 1 cent. 90 years and counting. But here is where it gets scary. If you have more than $250,000 in a single account at a single bank, that excess amount is uninsured. And when Silicon Valley Bank collapsed, roughly 94% of its deposits were uninsured. 94%. That is according to the FDIC's own data. We are talking about billions of dollars sitting above that insurance line. Those depositors, many of them small businesses with payroll accounts, did not know if they would ever see that money again. So why does this keep happening? Why do banks that seem perfectly solid on Tuesday just vanish by Friday? The core mechanism is something economists call a maturity mismatch. Banks take in your deposits, which you can withdraw at any time, and they lend that money out in long-term loans and investments that cannot be instantly converted back to cash. Your money is not sitting in a vault somewhere with your name on it. It is out working, in mortgages, in bonds, in commercial loans. This is actually how banking has worked for centuries. And most of the time, it is totally fine, because not everyone withdraws their money at once, until they do. This is what economists call a bank run, and it is arguably the most destructive force in all of finance. Diamond and Dybvig, two economists who won the Nobel Prize in 2022 for this exact research, published their foundational model in 1983, showing that bank runs are essentially self-fulfilling prophecies. The moment enough people believe a bank might fail, they rush to withdraw their money, which causes the bank to actually fail. It is a psychological loop. Fear creates the very outcome that people are afraid of. And here is what has changed in the modern era: speed. When Washington Mutual collapsed in 2008, customers withdrew $16.7 billion over a 10-day period. That was considered devastating. When Silicon Valley Bank collapsed in 2023, depositors tried to withdraw $42 billion in a single day. One day. $42 billion. That number comes directly from the FDIC's post-mortem report. Professor Anat Admati at Stanford has written extensively about how digital banking and social media have fundamentally accelerated the bank run phenomenon. A rumor on Twitter, or I guess we are supposed to call it X now, can trigger a nationwide panic before the bank even opens its doors. The Silicon Valley Bank run was largely coordinated through group chats and social media posts among venture capitalists. By the time management realized what was happening, it was already over. There is also the interest rate problem. Professor Marcus Brunnermeier at Princeton has studied how rapidly rising interest rates devalue the bonds that banks hold on their balance sheets. When the Federal Reserve raised rates aggressively in 2022 and 23, banks that had loaded up on long-term bonds during the low-rate era suddenly found themselves sitting on massive unrealized losses. Silicon Valley Bank had approximately $15 billion in unrealized bond losses before it collapsed. That information was technically public, buried in their financial filings. But most everyday depositors never read those filings. The final mechanism is concentration risk. When a bank's customers are all in the same industry, or all the same type, they tend to need their money at the same time. Silicon Valley Bank's depositors were overwhelmingly tech startups funded by the same handful of venture capital firms. When one VC told their portfolio companies to pull their money, they all did, simultaneously. Understanding these mechanisms matters because it tells you what warning signs to look for. Rising interest rates plus long-duration bond holdings plus a concentrated depositor base, that is the recipe. And you can actually monitor some of these factors yourself. Okay, so now the part you have been waiting for. What do you actually do about this? How do you protect yourself, specifically? Step 1, and this is the most important thing I will say in this entire video. Check your FDIC coverage right now. Go to the FDIC website. They have a tool called EDIE, the Electronic Deposit Insurance Estimator. You type in your bank's name, enter your account details, and it tells you exactly how much of your money is insured. Do this today, not tomorrow. Today. Step 2. Understand the ownership categories because this is where most people leave money on the table. The $250,000 limit is per depositor, per bank, per ownership category. So if you have a single account, that is covered up to $250,000. But if you also have a joint account at the same bank with your spouse, that joint account gets its own $250,000 per co-owner. And if you have a revocable trust account naming your 3 kids as beneficiaries, each beneficiary adds another $250,000 in coverage. A married couple with 2 kids could theoretically have up to $1.5 million in FDIC coverage at a single bank, if they structure their accounts correctly across individual, joint, and trust ownership categories. That is not a trick. That is literally how the system is designed to work. Most people just do not know about it. Step 3. If you have significant savings, spread them across multiple banks. This sounds obvious, but almost nobody does it. Each separate FDIC-insured bank gives you a fresh $250,000 coverage limit. So if you have $500,000, put $250,000 at Bank A and $250,000 at Bank B, fully insured. Done. And here is a hack that makes this effortless. Services like IntraFi, formerly known as CDARS, will automatically spread your deposits across a network of banks for you. You make one deposit at your primary bank, and they distribute it behind the scenes so that every dollar is fully insured. You can get FDIC coverage on multi-million-dollar deposits this way. Step 4. Keep some money in a Treasury-only money market fund. These are not bank deposits, so they are not subject to bank failure at all. They hold short-term U.S. Treasury securities, which are backed by the full faith and credit of the United States government. Fidelity, Vanguard, and Schwab all offer them. As of early 2024, some of these funds were yielding over 5%, so you are getting safety and a decent return. Step 5. If your bank is a credit union instead of a bank, your coverage comes from the NCUA, the National Credit Union Administration, instead of the FDIC. But the coverage amount is the same, $250,000. The rules work almost identically. Step 6. And this one is often overlooked. Know what is not covered. Investment products sold by your bank, like stocks, bonds, mutual funds, or annuities, are not FDIC insured. Even if you bought them inside your bank branch, even if the bank's name is on the account. This catches people off guard all the time. If your bank sells you a mutual fund and then the bank fails, the mutual fund is actually fine because those assets are held separately. But if you thought your investment account was insured like your savings account, it is not. Step 7. Pay attention to your bank's health. You can look up any bank's financial condition on the FDIC's BankFind tool. Check their Tier 1 capital ratio. Anything above 10% is generally considered well capitalized. If your bank's ratio is dropping towards 6 or 7%, that is a yellow flag. Professor Admati recommends that banks should hold far more capital than regulators currently require. Her book called The Banker's New Clothes makes a compelling case for this. Let me give you a real-world scenario. Say you and your spouse have $600,000 combined. Here is what I would do. $125,000 in a single account in your name at Bank A. $125,000 in a single account in your spouse's name at Bank A. $250,000 in a joint account at Bank B. And the remaining $100,000 in a Treasury money market fund. Every single dollar is protected. And it took maybe an afternoon to set up. Let me bring this all together because we covered a lot of ground today. In the first part of this video, we looked at the raw numbers. More than 560 bank failures since 2000. 2 of the 3 largest bank failures in American history happened just last year. The FDIC insures up to $250,000 per depositor per bank per ownership category. And in 90 years, they have never failed to pay out. But anything above that line is at risk. In the second part, we talked about why banks fail. Maturity mismatch. Bank runs fueled by social media and digital withdrawals. Interest rate risk on long-duration bonds. And concentration risk when all of a bank's customers are in the same boat. Nobel Prize-winning research from Diamond and Dybvig showed us that bank runs are self-fulfilling prophecies, and modern technology has made them faster and more dangerous than ever. In the third part, we got practical. Check your coverage with the EDIE tool. Understand ownership categories to maximize your insurance at a single bank. Spread deposits across multiple banks or use a service like IntraFi. Consider Treasury money market funds for an extra layer of safety. Know what is not covered. And monitor your bank's financial health. Here's what I want you to take away from this video above everything else. The system actually works if you understand the rules. The FDIC has a 90-year perfect record. That is genuinely impressive. But it only protects you if you are within the limits. And the difference between being within the limits and being outside the limits is just knowledge. That is it. It is not about being rich or poor. It is not about being a finance expert. It is about spending 15 minutes on the FDIC website to make sure you are covered. The people who lost sleep during the Silicon Valley Bank collapse, the small business owners who did not know if they could make payroll on Monday, most of them were not reckless. They just did not know the rules. Now you do. If this video helped you, or if it made you think even a little differently about where your money sits, hit that subscribe button. I put out videos like this every week, breaking down the money topics that actually matter for real people. Not Wall Street traders, not crypto bros. Real people trying to make smart decisions with their hard-earned money. I am Joe, this is Joe Invests, and I will see you in the next one.